Good morning and welcome. I can see people just logging on, so we'll give it about 20-30 seconds before we kick off. Thank you. Good morning. I'm Olive Gahan. I'm a director here in Mazars and I head up the actuarial practice of Mazars in Ireland. I'm delighted to welcome you to our IFRS 17 webinar today. There's just 120 weeks to go until the 1st of January 2023 and go live of IFRS 17. We now also have a finalised IFRS 17 standard. So it is critical that we use these 120 weeks well. We hope that our webinar today will help you in that regard. Over the last year to 2 years, I'm sure many of you will have attended a number of IFRS 17 events that will have given you an overview of the standard, an understanding of the scope, an appreciation of the general measurement model and of the variations thereof in terms of the variable fee approach and the premium allocation approach. It is now time to get into the detail, to get really under the hood of IFRS 17. And our webinar today will take you into some of that detail. To begin, my colleague Vinit Mundra will take you through the detail of discount rates. He will look at the two approaches set out in the standard, the top-down approach and the bottom-up approach, and will also look at how you might leverage your existing processes. Ciara Brown will then look at disclosures, covering the three categories of disclosures set out in the standard, and again we'll look at some examples of these. Our third speaker is Dara Pelly, Chief Operating Officer and co-founder of Raytig Software Limited, and also an experienced actuary. Dara will then challenge you to consider an alternative implementation approach with a view to delivering a more efficient and comprehensive IFRS 17 solution. But before we begin, I have a few housekeeping notices for you. Firstly, I'd like to make you aware that this session is being recorded. A link to the recording and to the slides will be sent to all attendees after the event. We will have a Q&A session after our three speakers have completed their presentations. At that stage, we would be delighted to take your questions. Between now and then, you're welcome to submit your questions via the questions or the chat panels on your screen. But at the time of the Q&A session itself, we will enable raise hand functionality and we'll go directly to anyone who wishes to ask a question at that point. So that's it from me in terms of the introduction, and I am now going to hand over to Vinit Mundra to take you into that detail of discount rates. Over to you, Vinit.
Thanks, Olive. Hello and good morning, everyone. For those of you who don't know me, my name is Vinit Mundra and I'm a fellow actuary from Institute and Faculty of Actuaries in UK and here Society of Actuaries here in Ireland. Today I'm going to touch on the topic discount rates under IFRS 17. And over the next 20-25 minutes, we are going to look at why are discount rates important and what do the standards say about it. We'll also discuss various approaches recommended in the standards. And finally, we'll also look at if we can leverage Solvency II or any other existing processes to set up the discount rates under IFRS 17. So why are discount rates important and why does it matter? Like any other standards, discount rates under IFRS 17 is also used to calculate the most key component of the balance sheet, which is the technical provisions. And for IFRS 17, the technical provisions is made up of fulfillment cash flows and contractual service margin, which is impacted by the discount rates and many other factors as well, but discount rates is one of the key ones. It is also going to impact your profit and loss or other comprehensive income, which would arise from the mismatch in the returns on the investment held and the discount rate as you roll forward your liabilities. Moving ahead, we'll see how the discount rates, what do the standards say on the discount rates. So paragraph A36 in the standard sets out 3 key requirements. Well, the first would be the market consistent one. So it wants the discount rate should be market consistent, similar to Solvency Due. The second key requirement here is that the discount rate should reflect the liquidity characteristics of the liabilities. And the third and the most important one is that it should exclude all irrelevant factors. And from irrelevant factors, I mean the factors that do not impact on your liabilities. So what we make out of this is that the standards really want your discount rates to be liability centric and not asset centric. And you will see as we go ahead in the presentation, we'll build on this theory. Paragraph B74 in the standard sets out the requirement for cash flows that vary or do not vary with the underlying investments. So what it says is if the cash flows do not vary, there is no need to adjust the discount rates for the variability in the return, which makes sense as the cash flows are not related to the returns from the underlying investments. But for the cash flows that vary, there is a need to adjust the discount rates for this variability, unless adjusted otherwise, the cash flows. This does not sound consistent with the requirement of market consistency that we just saw in the paragraph A36. However, as we go ahead in the standards, we see in the paragraph B77, it throws a clarification that if the product has both type of cash flows, companies can adopt a consistent approach. And so adjusting for variability is not a definite requirement here. So moving forward, we'll go into the details of the 2 approaches recommended by the standard that are bottom-up and top-down. In the slide in front of you, we'll discuss what do the standards say on the bottom-up approach. So what I've done is I've highlighted some of the key comments in paragraph B79 talking about the bottom-up approach. So the first one here is that it is for the cash flows for the contracts that do not vary based on the returns. Now, this does not mean that the other approach, which is a top-down approach, is not suitable for such contracts. It is equally suitable, and we'll see that in our presentation today. The yield curve will differ by currency, which makes sense that the yield curve should reflect the currency of the cash flows that it is discounting. There should not be any credit risk. Again, this is one of the irrelevant factors that should be excluded from the discount rates. And finally, it should reflect the liquidity characteristics of the liability. Again, the liquidity of the assets and liability could differ, and we need to allow for this fact while setting your discount rates. In the next slide, the slide gives the pictorial representation of what we just discussed under a bottom-up approach. And the bottom-up approach just sounds like something you start from scratch and build upon. And this is what the picture in front of you is showing, that you start with a liquid risk-free rate and add an illiquidity premium to set up the discount rates. So the liquid risk-free rate, we'll see in our next slide that how do we get it. And the illiquidity premium here is that it should reflect the premium based on the liquidity characteristics of the liabilities. All sounds easy, but now in this approach, you will see how it can be challenging to get the final answer. So I can see the slide is really wordy here, but I'll give a very detailed overview so that people can understand what we are trying to talk about here at a very high level. So the first step while constructing a discount rate would be to identify a liquid instrument with preferably negligible credit risk. This would be example bonds and swaps, government bonds and swaps. Well, the issue here is that the short-term nature of these liquid instruments, and so the curve that you would relate to these instruments would not be suitable for discounting the long-term liabilities, and so you may need to fit a long-term curve to these liquid instruments in order to make it suitable for the term of the liabilities. So in step 2, there are some models like Smith-Wilson and Nelson-Siegel that could be used to fit a long-term curve to this short-term liquid rate curve. So Smith-Wilson model, people familiar with Solvency II would know that the model is being used by EIOPA to construct the EIOPA spot rates, and they also provide an Excel model which can be used to fit a long-term curve. I'm not going into the detail of these two methods, but if you have any questions in relation to that, I'm happy to answer at the end of the presentation. Once you have fitted the long-term curve, in the third step would only be necessary if the instrument that you have selected in the first step includes any sort of credit risk in it. So I gave an example of government bond. The government bond can also have some sort of credit risk in it, and if you select that instrument, you may need to get rid of those credit spread adjustment in the yield for these instruments. So that's what's being explained in the third step, and there are different methodologies for identifying the credit risk premium for these instruments, which we are going to discuss in detail in the top-down approach later in the presentation. So once you have the credit risk adjusted, long-term liquid risk-free curve fitted, the final step of the process is to estimate an illiquidity premium, and this is the most challenging part, and the mechanism is not explicitly detailed in the standard, and so we have identified a couple of approaches to how to calculate this illiquidity premium that should reflect the characteristics of liabilities and not assets. That is the key point to note here. So in the next slide, you can see there are two approaches here. The first is the liability-based approach. So liability-based approach is preferred for non-participating contracts. Why is this? I'll just explain as I explain the methodology to derive discount liquidity premium under this approach. So under this approach, you need to identify the degree of liquidity for an insurance contract and attach a premium to it. Now, it sounds easy, but how are you going to do it? There is no market observed price for an insurance contract, so how can you derive a premium for the liquidity of a group of insurance contract or a group of insurance contract? You cannot, and so you need to calibrate these projected liability cash flows to match it with a portfolio of assets, preferably again bonds and swaps. So you need to do this matching exercise where you derive a reference portfolio, as we call it, which should match the nature of the liabilities. And once you have the reference portfolio, a matched reference portfolio, you just need to determine the spread for this portfolio and remove the credit spread adjustment from the spread. The remainder is your illiquidity premium. Now again, the way I explained it, it all sounds very easy, but again, there are a lot of paths to it which contains a lot of challenges and a lot of judgment needs to be made. Again, you'll see this in the end of the presentation. Right, so that's the liability-based approach. Moving on to the asset-based approach now. This approach is preferred for a participating type contract. So why I call it an asset-based approach is, unlike the liability-based, we start with a portfolio of assets here and not looking into the liabilities first. So and considering a portfolio of assets, is easier for a participating type contracts because you can directly select the underlying investment for these contracts, preferably again the mix of bonds and swaps. I keep saying that because that's the most suitable asset class to use. So once you have identified the reference portfolio of assets, the second step is similar to the final step of the liability-based approach, where you determine the spread of the portfolio and remove all the credit spread adjustment to derive the illiquidity premium. But this is not the final illiquidity premium under asset-based approach, because the point to note here is that we have started with an asset and not necessarily it reflects all characteristics of the liabilities, and so we need to ensure that your discount rate, your final discount rate or the liquidity premium should be reflective of your characteristic of the liability. What is not matching here is the duration of the assets and liability, which could be very different, and hence in order to adjust this, you can make a simplified adjustment where you calculate the duration for your assets and liabilities, take a ratio and multiply it with the liquidity premium to derive your final premium that could be used in a discount rate. So let's do a quick roundup of what we just discussed, and I'll just give you a quick overview of the key points under this approach. Credit risk premium, the methodology to derive a credit risk premium is key under bottom-up approach, and you will see that it is going to be key under top-down as well. So regardless of whatever approach you take, you need to have a process in place to identify or to calculate these credit risk premium. Once you sort this out, under bottom-up approach, deriving a liquidity premium would be slightly easier in the context of par contracts. However, for non-participating, the matching exercise can be challenging. Well, some of the companies might already have a process of asset liability management. Like if they are into annuity business, they have this. It would be slightly easier for them given they have the match portfolio. But for for the companies that don't have this in place, they may need to find a way of identifying this reference portfolio. The slide in front of you details some of the other key considerations, and I'll just list out the most important ones. So whether you calculate the illiquidity premium at a product level or entity level, this is very important given the amount of work companies want to do, and they need to justify why using at an entity level would be suitable. And then again, selecting an approach to estimate the CRP, credit risk premium, which is again very important. You need to be the approach needs to be suitable. And finally, we'll see if we can leverage the Solvency II. We need to consider if we can leverage the existing Solvency II process. Now, both the item that I just mentioned is discussed in this presentation in the final slides. So let's move ahead and see, move to the next approach, which is the top-down approach, and let's see what this has to offer to us. Paragraph B81 in the standard discuss the requirements of top-down approach. Two key points, or the first two key steps in this approach, is setting a reference portfolio for the contract and estimating the yield curve for this portfolio. Now, setting a reference portfolio for the contract, again, easier for participating type contract where you can use the underlying assets, but challenging for a non-participating contract where you may need to have a matching exercise carried out. So we'll see how this could be sorted for different types of contract, but this is one of the key steps of the top-down approach where you need to find the reference portfolio that reflects the nature of the liabilities. And once you have done it, the process gets slightly easier where you identify the yield curve for the mix of assets. And once you have the final yield curve, you need to remove all the irrelevant factors like credit spread risk from the yield curve. So the issue here is that standard does not comment on how to construct this reference portfolio or how to put an estimate to these irrelevant factors. Now, these are the loose ends of the standard, which you have already noticed, like even in bottom-up approach, these loose ends will come up and in the top-down as well. And this is where companies need to come in and make some judgments and identify the right methodologies. But there is another point in this standard. If you look at the final line of the slide, final point of the slide, the point here kind of throws away the whole idea of making the discount rates liability centric, which we saw at the start of this presentation. Like it says that it is not required to adjust the yield curve for difference in liquidity characteristics. This does not make sense to me, given the requirement in paragraph A36 is to keep the discount rates. Discount rate should reflect liquidity characteristics of the insurance contract. But how I read this paragraph is that the standard is expecting the liquidity characteristics to be captured in the reference portfolio that you identify. So from the standards point of view, the reference portfolio is already reflective of the liquidity characteristics of liability, and hence you don't need to make any adjustment on for the liquidity later in your yield curve. We are going to build upon this assumption that your liquidity characteristics should match between your assets and liability in your discount rate. Now, this slide here again is the pictorial representation of top-down, unlike bottom-up, where you start from the scratch and build upon it. In top-down, you have something already, like for the yield curve for the reference portfolio, and then you start taking out the irrelevant pieces. from the point of view of liabilities. So this here just gives you the pictorial representation of what we just discussed. So let's move on to the next slide. But before we discuss the top-down approach in greater detail, I would just like to tell you that there are going to be some stark similarities between bottom-up and top-down approach, where you will see some sort of circular references that, oh, we just saw the bottom-up slide, the top-down approach was in there, so why is it coming up again? So this might create some sort of confusion in your head. It's great if it's not. That means I'm doing my work job very nicely. But if it does, don't hesitate to ask any questions at the end of the presentation for me. So in this slide here, the first step under this approach is to make a selection of reference portfolio. Again, as I said, like this could be a task where which could be easier for participating contracts, but for non-participating contracts, you need to do some sort of matching exercise where you get the right reference portfolio matching the nature of the liabilities. Right. So once you have the reference portfolio of assets, what you need to do is identify the yield curve for that reference portfolio, and in the second step, as you see, you need to calculate the credit risk premium for that particular portfolio. Once you've done that, you need to remove the credit risk premium from your yield curve. There are various methodologies, and in my next slide, in my next couple of slides, I'm going to talk about the various methodologies that are available and widely used to calculate this premium. Now, the third step is only necessary if you have any mismatch between asset and liabilities when you selected your reference portfolio. Like, for example, if you for a participating contract, if you use the underlying investment as a reference portfolio, you may see some sort of mismatch in duration between the liabilities and the assets. So you may need to adjust this in this third step. Or for non-par, if you have taken any simplified way of identifying the reference portfolio without doing the matching exercise, you may need to address all these mismatches in this third step. From my view, it is advisable to get all the mismatches sorted in the first step to avoid any more judgments, but it all depends on the most feasible approach that we are going to take. So once the credit risk adjusted and all of the mismatch adjusted yield curve is ready, we need to extrapolate this yield curve to match the term with the term of the liabilities. And similar to the one that we discussed in the bottom-up approach, the two methods that are available are Smith-Wilson and Nelson-Siegel, to extrapolate this curve to get the long-term curve. Now, what we see here is that there are two key components of the top-down. That is to set a reference portfolio and to estimate a credit risk premium. These are the two key pieces. Setting a reference portfolio can be very product specific. As I said, like could differ for par and non-par, and again within non-par you can have different types of contracts. But the approach for estimating the credit risk premium can be very general and common across the product lines. So in this slide here in front of you, I'm going to discuss what a credit risk premium is. So in a very layman language, credit risk premium is the reward for the risk of default borne by a bondholder. So sounds easy, okay, but where do you see the credit risk premium? How is it in an yield? So for example, a corporate bond, the yield for a corporate bond is a sum of basic risk-free rate, and then a credit risk premium, which reflects the risk of default, and then a premium for holding the bond for a longer term, so which would be the illiquidity premium. Sorry. So these are the three key components of a yield of a corporate bond. Now, what we are going to focus on here is the credit risk premium. The credit risk premium is made up of two components here, which is the expected credit losses and the unexpected credit losses. The first here is the expected level of default. In the statistical terms, is a median. In the statistical term, is just the median of the expected losses, and the unexpected credit loss is the loss which could arise in the extreme events. Again, in the statistical terms, it's just the losses on your tail. While the first is easy to derive, the second could be really complex from modeling point of view. In the next slide here, I'll just talk through some of the three widely used models or most feasible ones to use to calculate this premium. The first is a structural modeling techniques, where there are models available in the market, statistical models like Merton and Vasicek, which could be used to calculate these probabilities of default and the loss given default. And there are third-party providers of these models. Some companies may already be using this in their ESG modeling, so this could be leveraged in your credit risk premium derivation. The second method here is the historical analysis, in which you derive the probability and losses, probability of default and the expected losses looking at the historical information. The drawback of this approach is it's not forward-looking, but you can take comfort from the fact that the items like MA and VA under Solvency II is based on historical analysis. Third is not the most commonly one, which is the market-based method, where you look at the spread for the instrument credit default swaps. It's not the most commonly used, but it's a simple way of looking at the credit spread. And there are two driving concerns of using this approach. These are very short-term in nature, so there will be a need to fit a long-term curve to these spreads. And the second issue with this is the instrument has got its own liquidity risk, so you need to adjust the liquidity component to make it suitable for the reference portfolio. So these are the two approaches that we just discussed, and we have seen a lot of various bits and pieces to these approaches. Let's see if we can leverage our current Solvency II process. So if we can resolve any of these items or issues that we just looked at, for which we don't need to set up a new process. So if you compare the two standards, Solvency II is more asset-centric, however, the IFRS 17 is more liability-centric. And when you see how we set up the discount rate under Solvency II, it's more of like a bottom-up approach, where you start with a liquid risk-free rate and then add matching adjustment or volatility adjustment on top of it. But the process for determining the matching adjustment of VA is a top-down approach, where you look at the spread of the assets and then you remove the fundamental spread, that is the credit risk spread, to derive the final matching adjustment or the volatility adjustment. So it's a mix of bottom-up and top-down. And if you think this would, if you could recall what we just saw under the bottom-up, this sounds very similar to the approach we looked at, where we have the liquid risk-free rate. But to derive the liquidity premium, we need to do the whole top-down approach to identify the reference portfolio, determine the spread, and take out the and the remainder is the liquidity premium. So stark similarity, but there will be, the estimates will differ, the assumptions might differ, so that would require more judgment. If the companies can demonstrate that their liabilities are highly liquid, there would be no harm in using the EIOPA spot rates. But again, some justification need to be made. I'll just talk about it in a few seconds. Also, in case of annuity business, where the reference portfolio matches the liabilities, usually Solvency II matching adjustment can be leveraged with some justifications, definitely. Also, if the company opt to go with the bottom-up approach, there is no harm in starting with EIOPA spot rates at the starting point. However, there are items like ultimate forward rate, last liquid point under the Smith-Wilson method, where Solvency II or EIOPA make assumptions for these rates of these points to fit a long-term curve to EIOPA spot rate. So these assumptions needs to be justified under the IFRS 17 before you could go and use it. So there's some work to be done, but definitely some leveraging is possible. There is also some synergies between for the calculation of the credit spread adjustment between the two, like items like the calculation of probability of default or loss given default under Solvency II can be leveraged for IFRS 17. So these are the few common grounds between Solvency II and IFRS 17, and we can definitely see that it is possible to leverage Solvency II with some additional work to be done. In the end of my presentation here, I have concluded with few key points to consider, and the first 3 points you could see that I have already discussed this in detail, and now you can see how important these 3 items are, like yield curve, credit risk premium, and the liquidity premium. I'll focus on the remaining important points to consider, which is to justify the judgments you make, like using Solvency II or the methodology to calculate credit risk premium, things like that needs to be justified under IFRS 17, because there are a lot of open-ended. There is no clear-cut recommended solutions under IFRS 17 like Solvency 2. So all these judgments you make needs to be justified. And you also need to see the impact of the choice you make on the balance sheet and the P&L. It is very key. The mismatch risk that I talked about at the start, it could be huge depending on what you choose. Also leveraging internally and externally available resources, so like leveraging Solvency 2, or the companies might already have credit spread modeling in place, so they could use this for IFRS 17. And finally, the most important piece is the operational implication, that how you're going to integrate the new process with the existing process. Can you have some sort of synergies used, or what's the cost benefit analysis of having this in place? So things like these needs to be addressed or considered. So with this, I would like to end my presentation here on discount rates. I'll be more than happy to take any questions in the end of the presentations. You can put that in the chat box now, and I'll hand over to my colleague Kira to discuss the disclosures under IFRS 17. Thank you very much.
Thank you, Vinit. My name is Kira Brown. I am an actuarial manager here in Mazars. In my presentation now, we're going to step back and look at the disclosure requirements under IFRS 17. I think the disclosures are often mentioned at the end of an IFRS 17 presentation, almost as the last thing that is thought about, but I think it's really worthwhile keeping them front and center throughout your project, because there's a lot of different operational implications and practical issues that could arise. So this first slide is just a reminder of the disclosure principles. Essentially, nothing has really changed, similar to any accounting standard. We're just trying to explain the numbers in our financial statements as well as we can to the users of the financial statements. The difference between IFRS 4 and IFRS 17 here is because IFRS 17 has introduced so many new concepts and so standardized a lot of terminology, then the disclosures themselves are able to be that much more prescriptive and detailed. So there's three broad categories. There's the quantitative disclosures that are explaining the numbers. There is disclosures about the judgment you applied in using IFRS 17, and there's disclosures about the associated risks of the underlying insurance contracts. And I'm going to explain those in more detail in the next slides, but before going into that, I would just draw your attention to the level of detail you're going to use. So IFRS 17 has some explicit statements there about granularity, that the disclosures need to provide the right amount of information to the users of the financial statements. So the examples used in the standard are, providing the disclosures by line of business or by geographical area or by reporting segment. So whatever decision is made there is going to have lots of knock-on impacts, both on how the disclosures look and on what you need to produce them. So on the first category of disclosures, on the next slide, we have a table that sets those out. So there's an awful lot of new disclosures here. Some of them vary depending on what model you're using. So I've indicated there whether it's a general measurement model, a VFA, or a PAA disclosure. Many new ones, and then the two that aren't new, the reconciliation tables are significantly expanded. There's an awful lot more detail, as you'll see a little bit later on in my example. The other ones are basically explaining the new concepts under IFRS 17. So the insurance revenue and the insurance finance income and expenses, these are brand new numbers, and they do require those extra explanations and extra quantitative detail within the disclosures. There's also specific disclosures about the new business acquired during the period and explanation of the runoff of the CSM that you expect. Then there's some specific ones if you're using the VFA model. There's 111 to 113 there are all specific to the VFA. And then there's some additional disclosures at the end there about the contracts that are in force at transition. So whatever contracts you have on the books in January 2023, you're going to be providing extra information about the impact of those for the rest of their lifetime when they're on the books. So the second category there about judgments, here there's going to be quite a lot of interesting information, I think, for comparing between different companies. If you think about what Vinit was talking about the estimation techniques you're going to use when coming up with the discount rates as just one of the various elements that needs to be disclosed in this section. And you're going to be able to look at the disclosure of paragraph 117 and the disclosure of 120, see what method this company is using to determine its discount rates and what actual yield curve it ends up using at the end of that process. So I think that will be quite interesting in terms of market comparisons and may lead to some more market convergence. Similarly, for 119 on the confidence level of the risk adjustment, I expect there's going to be a lot of comparisons between different companies and potentially pressure to converge to the market there. The third category about the risks underlying the insurance contracts themselves. This is similar to some of the information that's already in financial statements, but it's really being built upon by the new IFRS 17 requirements. There's more detail required, and I think when this information is provided at line of business or geographical segment level, there's going to be more detail than you currently see, and you'll see that in a moment with my example. So next we're going to just go through 3 disclosures examples. Obviously there's an awful lot of them and it would take too long to go through all of them, but just at a high level I'm going to go through these 3 and they're just for illustration purposes. So the first one is the first of the 2 reconciliation tables, and I can really see these reconciliation tables being some of the most difficult disclosures to produce. They're quite detailed and prescriptive in terms of what needs to be included. So this reconciliation is by liability for remaining coverage and liability for incurred claims. So basically we're breaking up the past coverage in terms of the incurred claims and the future coverage in terms of the remaining coverage of the rest of the lifetime of the insurance contracts. And then that piece itself about the future is broken into what you expect to be loss making in the future, the loss component, and what you expect not to be loss making. And this table here should bring you from the opening balance of that line of business's carrying amount down to the closing balance at the end of the year, and reconcile that with the IFRS 17 profit and loss impacts. So reconciling it with the new concepts under IFRS 17, the insurance revenue, the insurance finance expenses, and so on, with the actual cash flow. So the bottom half of the page is the actual cash flows, the more traditional measures we're familiar with in terms of premiums, claims and benefits, and acquisition costs. And it's worth drawing out here that the IFRS 17 new model that's built that calculates your CSM and risk adjustment and has all these features might not have any impact on the existing systems that capture cash flows. So therefore those 2 systems might be built completely differently and not speak to each other, and there's probably scope for differences to arise between those 2 systems, especially when you break it down to line of business level or reporting segment level. So that could lead to issues in trying to reconcile this table. So it is definitely important to think this through at the start of your project and at different points throughout to figure out whether this will reconcile, and if it doesn't reconcile, how will you figure out where there's an issue, where how will you troubleshoot this table. And then I'm not sure that I mentioned that this table needs to be produced for all the reporting segments and also for both for insurance contracts issued and for reinsurance contracts held. So this is very much a simplified example where there's no reinsurance. So there could be quite a lot of information and many versions of this table. So just bear in mind that, even after you've produced the balance sheet and the P&L, there's a lot more numbers to be produced in this section. So moving on to the next example, this is a disclosure showing the CSM runoff. So I think this is an interesting disclosure. It's new, obviously the CSM as a concept is new, and it shows an awful lot of visibility into that company's expected profit profile over the next 20+ years by those line of business or reporting segments, whatever you're reporting by. And I think if you think about this from the point of view of a third party, maybe an investor or a potential acquirer, they can see just from your financial statements quite a lot of information about where you expect profitability to be in the future, and how quickly that'll arise, and if changes happen between one set of financial statements and the next set the following year, they're going to be able to see how exactly that impacted your CSM estimates. So I think that will be a really interesting one to look at. And then the third example I'm giving is a sensitivity analysis. So there's a requirement for a sensitivity analysis of your key insurance risks and market risks to be performed. I've shown this to kind of give you an idea of the level of detail that's required, again, because if you were to do this for multiple different lines of business, each one of them might have different key risks, and you've got to show the range of reasonably possible changes in those key risk variables at the valuation date. There could be, many more numbers in this table, and each one of them will require reruns of your CSM engine and reruns of, your entire profit calculation. So it's really important to figure out how flexible your model is going to be and whether you're going to be able to capture this and reproduce these numbers quickly at year end when you need to close your financial statements down. That's the insurance risk one. There's also a market risk version of the same sensitivity analysis, and the difference with this one is that IFRS 17 has explicitly asked for this to be broken down by insurance contracts and by financial assets. So there's going to be some interesting information in this one too, because you'll be able to see any mismatches that apply in those lines of business. So there's quite a lot of new information there and more detailed information than you would have seen under IFRS 4 financial statements. So with that, I am going to wrap up and hand over to Dara. I think that it's really useful to bear all those disclosures in mind as you go through the implementation process, and hopefully that'll make even more sense with you go through Dara's presentation. I'll be around for questions at the end.
Cheers, thanks Ciara, and thanks to Olive and Mazars and team for inviting me along today to share some of my insights from implementing IFRS 17. As Olive mentioned, I'm Dara Pelly, the COO of Raytig Software. At Raytig, we've developed an IFRS 17 administration platform that allows insurance companies to manage and automate all of the various activities that support the end-to-end financial reporting process. And today I want to give some insights on your implementation project for IFRS 17. So before we jump into the implementation project and approach, we maybe take a step back and just kind of redefine the problem statement. What is IFRS 17 and kind of what challenge does it present to us? So the answer to that has layers to it. At a very superficial level, when you look at this, Google IFRS 17, what is it? You'll see it's a change to how insurance companies report profit. So from a project sponsor, project owner, project manager perspective, you might look at that and think, okay, this is a reporting project, some inputs, and then some reporting outputs. Then you look a little bit further and you see, oh, well, it's actually about how we calculate and report profit. So now another additional layer of complexity. I'm going to have some sort of calculation engine. So I'm going to have some data coming in, some calculations, some data coming out, and then putting that into reporting. Then when you get into the standards and you really get under the hood, you start to see things mentioned. Okay, it's going to impact how I aggregate and manage data and the level of granularity requirements there. It's going to involve calculations and releasing profit. It impacts then, as Ciara showed there in her presentation, the financial statements and the related disclosures are all impacted as well. So from a project perspective, you're going to see this is going to involve multiple stakeholders: senior management, IT, ops, actuarial, accounting. It's going to involve a lot of data, gathering and managing a lot of data. It's going to involve complex calculations, and then it's going to involve disclosures and reports that go externally and that are very, very important to the company. So this is a big project with multiple stakeholders, multiple systems, and over multiple years. So quite a challenge for many of the project managers that are joining us here today. It's a significant challenge for you guys to implement there. So if we move along, and I'll just focus for now on three aspects that I believe are kind of core and fundamental to a successful implementation project. They're reporting, which Ciara touched on. Collaboration, I mentioned there's multiple stakeholders and multiple disciplines involved in this. And then looking at maybe an alternative implementation approach and trying to implement fail fast or an agile way of implementing this project. So if we look at reporting first of all, again, backing up very much what Ciara said there, you have the IFRS 17 standards, it's 132 paragraphs. You start off the first 100, discuss insurance and reinsurance contracts and grouping and level of granularity and aggregation, and they talk about measurement models and the discount rates, etc. that Vinit went through. And almost like an afterthought, the presentations start there. They're around the last 30 or so paragraphs. And it does feel very much like an afterthought, and especially because in the first 100 paragraphs, a lot of that stuff is very tricky and complex, and as people try and start to read the standards, you get dragged down a rabbit hole for much of these things. But ultimately, the presentations, the statements and disclosures, they are the primary business requirement. So if we look at this as a project and say, what are the business requirements that I'm trying to deliver here? That's the primary requirement, is the financial statements and disclosures. For me, the secondary requirements then are I need to be able to calculate CSM, I need to have the group contracts, all that sort of stuff as well. So I just kind of echo what Ciara had said there, and make sure or advise you start at the end. Get really comfortable with the statements and disclosures, because there's a massive influence as you go through those disclosures. It really influences your business requirements and what data do I need. So when I come and I talk to many people and I talk about actual cash flows and I talk about assets and credit ratings and that sort of stuff, they kind of scratch their head and say, well, like, what does that have to do with the CSM? And it's not necessarily the CSM. These are data that you need for the disclosures. So IFRS 17 is very much more than CSM and measurement models. So just don't miss that, and I would definitely start with it. So if we move on to the next piece then, collaboration. So, as I mentioned there a couple of slides back, IFRS 17, it's kind of invasive. It's going to impact multiple systems, multiple teams. It's more than just an impact on actuarial and accounting. It's going to impact your ops teams, and then you're probably either going to be upgrading or extending or implementing new software. So it's going to impact IT as well. So for a project manager and a project sponsor and project owner, you're going to have multiple stakeholders that you're going to have to manage and work with. And I think, for me, the most successful one is going to be a very collaborative approach rather than a very siloed approach. So before we implement, again, so we know what IFRS 17 is. We need to look at our reporting model, and there's two types of operating model that I see as I go around various insurance companies. So the first type is what we would call parallel processing. So this is where all of the various teams and functions, so policy admin and reinsurance and actuarial, they all kind of work independently. They do their own piece of work, and they ultimately send information into the ledger. They also send information to each other independently as well. So, policy admin will create a model point file to go into the actuarial modeling team and function, and then they'll create some liabilities and create some postings going into the statements. One issue, or well, a few issues with the parallel processing approach is, one is the chart of accounts and the accounting rules. You end up implementing your chart of accounts and accounting rules in multiple systems, and then for the finance function, it can be very hard to then control and know what's going on in all of the various systems and how the rules are being applied. And now IFRS 17 is going to come in and upset the apple cart and maybe require you to change that. And so now you're going to have to go around multiple systems and change those accounting rules. Another thing then IFRS 17 is going to bring in is the concept of the aggregation, so grouping of contracts or splitting up reinsurance contracts. So again, am I going to go into individual systems and do these things? So an alternative way that you can implement is what we call a hub and spoke approach. So this is an operating model where you allow the individual systems to focus on their primary work. But as far as accounting and aggregation and the collection of data goes, you get all of the systems to talk to the hub, and you get the hub to talk to all of the systems. So, you know, Ciara mentioned reconciling the actual cash flows and the, you know, expected liabilities that have come from actuarial modeling. If the policy admin team are feeding some information to actuarial modeling independently, and then both are independently writing to the statements, that's definitely going to cause reconciliation issues. Where if all of the inputs for actuarial modeling first come through your hub, and then your hub sends the information to the actuarial team and gets the information back again in the hub, it allows you then to perform the reconciliations at the point you are consuming and passing data, rather than at the end point seeing, oh, my disclosures don't add up. So it's really about catching issues early on and implementing a really controlled approach there. So, you know, I think this provides huge beneficial results to insurance companies as well, in terms of in the hub you will have both financial and non-financial data. So in the hub you'll have a list of all of your policies and all your reinsurance treaties, and you'll also have then all of the financial postings that you're going to create as well. So it allows you to perform a lot of management information where you want to have ratios of non-financial to financial information. So all that, bearing all that in mind, if we move on then, and we look then to, you know, the actual approach to implementing IFRS 17. So I'll start with a couple of quotes on the right here. So we have Sun Tzu and the Art of War. If you know the enemy and you know yourself, you need not fear the result of 100 battles. And then the Standish Group, who are an IT research advisory firm, they estimate that for every 1 million you spend on an IT project, which IFRS 17 will be a heavily IT project, it's going to result in about 1,500 decisions. So IFRS 17 is going to be multi-million spend for most companies. So you're looking at thousands of individual decisions. And if I look at IFRS 17, a little like a, whatever Olive said it was, 120 week war that's left, we're going to have thousands of battles in that war. So, you know, in order to come out and implement a successful project, we really need to understand ourselves. You need to understand your products, you need to understand your systems, and you need to understand your processes. And then you need to understand IFRS 17, the enemy. You need to understand your statements, your disclosures, and the rest of the standards around calculations. So all of that said, we have this, you know, very big, very complex multi-stakeholder project. And traditionally a project like that within an insurance company would be very waterfall and siloed. So in waterfall, what I mean by that is each of the individual teams would go out and they would, you know, define their business requirements, they'd read through the disclosures. Vinit would go off there for, you know, 6 to 9 months and figure out his discount rates. He'd write methodology papers, and then all the methodology papers all be pulled back together from various people, and let's hope they all interact well. Whereas what the Standish Group kind of say is they look for a more agile and a more collaborative way to do these sorts of projects. And they base that on the little graph in the bottom there. You'll see a general IT project timeline and two key kind of things that displayed on the graph. So one is the cost of change, and the other is the influence you have over the project and the solution you're delivering, and the uncertainty around the project and what you're delivering. So at the start of a project, influence and uncertainty are both high. So there's lots of risks, lots of unknowns, but you have influence to make changes. And the cost of those changes, if you get them early, is low. As you get to the end of a project and you've done significant amount of bills, you know, implementing change requests and that sort of stuff at that point in an IT project, costs can get very expensive. And generally what happens is the change doesn't get made where it should get made, and instead it gets made in Excel. And what you deliver is basically a couple of big chunky systems and lots of Excel files around the edges. So, you know, I would suggest, and how we work with our clients, is you try and implement a fail-fast approach, where you, in order to make decisions, you identify first the decision to be made, you hypothesize, you know, what you think is the right answer, you test that as quickly as you can, and then you either decide, oh, have I made the right decision or have I made the wrong decision, and then go back and hypothesize a different answer. And you work iteratively through the project in that way. So if we look at then IFRS 17 in specifics and the implementation project, I've broken this up into a 3x3 matrix. Starting with the 1, 2, 3 under A here at the top. So first point for me is a bit of desktop analysis. You really need to know yourself. So what we need to understand is under IFRS 4, under my current financial reporting model, how does that work? How do I get from source data through various systems and into my disclosures? And you know, that process will have evolved over many years, and doubtful, you know, any insurance company I've ever walked into doesn't have that fully well documented, and there's not necessarily one person in the building who fully understands it. It can be passed out to multiple people. It can also involve lots of Excel and manual workarounds. You know, you have a big admin system doing something and it produces an output that goes through some Excel macro to create a voucher for posting into SAP or JD Edwards or PeopleSoft or one of these big accounting tools. So it's really important that you know yourself in that respect. Then let's look at the enemy IFRS 17. So you can use what Kira has shown you there today to then compare, okay, so I know how I get data from source through systems into IFRS 4. Now let's compare, how does IFRS 17 compare to IFRS 4? You know, what's new, what's expanded, what's taken away. And then on the basis of what I did in 1 from 2, I can move on to step 3, which is to try and walk from the IFRS 17 disclosures back through the various systems and functions back to where I think the source data is going to come from. So very early on in the project, you need to get like a really good idea of how am I going to get data from source data through systems back out into the disclosures. And you know, as Kira alluded to in the disclosures there, the processing in the middle might be multiple reruns of your CSM engine for the sensitivity analysis. The disclosures there are going to require you to combine, you know, actual cash flows from your core admin systems with basically the expected cash flows, the CSM output from your actuarial systems at the same level of granularity. How am I going to handle all of that? Okay, and get an idea. Am I going to go parallel processing? Am I going to go hub and spoke? You know, am I going to just build onto existing systems, or am I going to implement something that's going to bring all this together? So given you now have a good kind of understanding of the challenge and what you need to do, next step for me is on row B and the 1, 2, 3 here of row B. So what I would do is I go through all of the standards, then allocate each of the paragraphs in the standards to various people. So, you know, discount rates, going to pass that over to Vinit, the disclosures, pass it over to Kira, CSM calculations, pass it over to Olive, etc. And then you get each of the team to, you know, in leveraging existing models or maybe just using an Excel as kind of a back of an envelope sort of thing, build out a real wireframe of what they need to do to perform the calculations they need to perform. Then bring all that together in a model office and look to, you know, get some data from each of those people together and then produce data that would go into the IFRS 17 financial statements and disclosures. So it doesn't have to go in with all the narrative and shiny output, but it's literally just try and get, you know, numbers from the left, from the various systems, bring them all together, see how those numbers interact. And, you know, Vinit's output is Olive's input, the discount rates being passed over to the person who's doing CSM, etc. So understand the interaction between the various people and start to build up a framework that you can pass data through to get some output in IFRS 17 format. So when we move on to C at the bottom, then that's the next phase of that. So now I have my kind of my wireframe of my operating model and the various systems and engines that I'm going to build. And what we want to do is 2 things. First is the system. So I need to replace my back of the envelope calculation for discount rates with, you know, an actual fully operational engine to do the discount rates. Likewise with CSM, you know, a lot of people are either extending actuarial models or bringing in external CSM engines. Let's replace the little Excel model that we came up with the actual CSM engine that's going to come in. So all of the various components, you start to replace the wireframe with what's actually going to come in. And at the same time with data, so start with just, you know, completely made up data. Just do a, you know, a policy walkthrough for the general life cycle of one of the policies you have. Then start to look at existing data that you have in systems. So maybe, you know, go back to 2018 or 2019 and try and pull in data that you had then for new policies. And then you want to iterate all the way through until you get to a position where you can start pulling out live data in a parallel processing, so that effectively you can be running the IFRS 17 end-to-end process while you're also doing IFRS 4. So that kind of concludes my insights. And again, just encourage people to look at the reporting, bring that very much to the start of the project. Collaboration, both on an implementation project perspective and on your BAU operating model. I definitely would advise a collaborative approach rather than something that's very siloed. Everyone goes away, does their own thing, comes back in 18 months' time, and then figures their piece of the jigsaw doesn't fit with someone else's, and you get into costly change. And then fail fast. Try to, you know, rather than going away for 6-9 months writing methodology papers and getting it all signed off, you know, actually try and test out your ideas before you sign off on those papers. Thank you very much.
Thank you very much. And thanks to Ciara and Vinit also. We're now going to go to a Q&A session. So for this session, we've already received a few questions, which we will go through. I would also invite you to raise your hand if you wish to do that. That functionality is now being enabled, and we'll keep an eye on it to see how many hands are raised and try to get you involved. But first, I'll go to some of the questions that we have received. And the first, I just want to make sure the screen is all okay for you there. The first question that we have received here is for Vinit and relates to life versus non-life. In fact, we have a few questions on this theme. So I'll go over to you, Vinit, and ask you to maybe talk about how things are going to be different for life and non-life actuaries in relation to the discount rate.
I mean, the one we discussed here is the only recommendation from the standard for setting up the discount rates. And when we talk about non-life, I would break it down into two types of contract, like which is usually very short-term and annual contract, or the contracts which is longer than the usual short-term contract. So like the P&C contracts, in my view. So there is no separate recommendation from the standard on the non-life contract. So if the contracts are longer than the usual short-term ones, where the discount rates are important or key to the calculation of technical provisions, either of the two approaches can be used, depending on what is suitable for the nature of the liabilities cash flows. So yeah, there is no separate recommendation.
A related question, I'll stick with you in case you have anything you'd like to add on that. It says, I would be interested in any insights in non-life versus life. I work in non-life and we are unsure how much to do as ALM is less sophisticated. Is an illiquidity premium likely to be justified or material for our business from what you've seen in the market?
So for illiquidity premium from a non-life point of view, I won't be able to comment on that, but certainly it is relevant from the life point of view. Business like annuities have got significant illiquidity premium coming through, given the contracts are not liquid up to a certain date. From the non-life point of view, I don't think so. Liquidity, from my knowledge, I don't think so. Liquidity would be an issue given how the non-life contracts are. You don't necessarily wait till a certain point of time or hold a contract till a certain point of time before you start paying out. So it's an event-based. So based on the events happening, you just need to pay out. So non-life contracts are highly liquid in nature in comparison to the life contracts. If you have to make a direct comparison. So in my view, illiquidity premium wouldn't be a key component for setting up discount rates for non-life contracts. If I've got your question correct, that's what my answer is. Yeah.
Thanks, Vinit. I'll go now to Ciara for the next question. Some of your examples were at line of business level, Ciara. At what level of granularity must the disclosures be produced?
Yeah, so that's a good question, because I know it was obviously a very quick run through the requirements, but if you have a look into all the way into paragraph, I think 94, it gives kind of a little bit of specificity on the IFRS 17 requirement on this. It's not absolutely prescriptive. It's all about trying to, place the correct amount of emphasis on the information you're providing so that it's useful to the users of the financial statements. So I use line of business because I think that that could be the way it goes depending on the company, but it will depend on what what amount of information it needs to be disclosed. So for some companies, it might just be 2 lines of business, it might be 5 or 6, but I think a lot of IFRS reporters have quite a lot of different activities on their books, so they need to find some sensible way of disaggregating it so that the information is more useful to the users of the financial statements. So it's unlikely to be just 1 line of business unless it's an incredibly homogeneous book, which I don't think really applies to most IFRS reporters.
Thank you, Ciara. That was great. I will go now to Dara. Dara, I have a question for you on resources. Would you have any thoughts on the resources that are required for an IFRS 17 implementation project?
Yeah, like as I mentioned there, it's a pretty big project, and I think really people are going to struggle to deliver this project just purely with internal resources. I think they're going to need external resources. With this, I don't think you have enough people in the business not doing anything at the moment to be able to do this, and people who do run the BAU at the moment, they don't, they just don't have capacity to do this. So I think you're going to bring in external resources, but I think you can, or you need to be really strategic about what you do there and learn lessons from Solvency 2. So from my experience, a lot of people with Solvency 2, they brought in some external help, and the external help basically did all the work and gained all the corporate knowledge, and then they were the ones that left then, and the business team were then left running what was built for them by someone else, without all the knowledge of all the decisions that were made and what was trialed and errored along the way. So just be really key around the resources you get in externally, and figure, do I use them to backfill instead of actually delivering the full project? And very much make sure your key people are heavily involved in the project, because there's going to be a lot of decisions that influence them in the next 10 years being made. And if those decisions are made without their full input, then you could make the wrong decisions and look for a quick win on implementation, which actually causes a lot of pain over the next number of years in BAU.
Thanks, Dara. I'd certainly echo that after many years involved in projects, and where you are bringing in external resources, it's important that there's good collaboration with internal people, so you definitely want to keep that knowledge. I'm going to go now to one of the hands raised. I'm going to see if I can unmute Brian Birch. Or Brian, if you unmute yourself, I think that should be possible, and we'll give you the mic.
Hi, Olive, can you hear me?
Yes, loud and clear. Welcome, Brian.
Great.
Good.
Hi, Dara. We've met before. Our business is one where we have a program business, but also acquired business or legacy business. So we'll continually buy books of business on a strategic, if you like, basis. And I'm wondering about the challenges of doing that. Certainly, we'll have come across data challenges before that. But in terms of IFRS 17 rules, how to value things, CSM and early profits and transition, how to negotiate those sorts of things. We think we've covered some of the rules, but any particular issues you might have come across or know about for companies that will continually acquire new books of business.
Is there anyone in particular you'd like to direct that towards, Brian?
Whoever is best suited.
Olive, I might jump in for one aspect on this from a systems perspective. That's very much where the hub and spoke model for companies like that are acquirers, and there's a lot out there. There's a lot of action on the kind of reinsurance side of things there. The hub and spoke model kind of allows you a kind of a plug and play model there, where if all of the logic and all of the aggregation is done in the hub, it's much easier then to plug in and get rid of various policy admin systems. So, you know, expense systems, commission systems, reinsurance, policy admin systems. If all of the data is coming into the hub and the hub manages the communication, then it's much easier to add on new admin systems, get rid of existing systems, and pull the data together to, you know, you'll possibly migrate into a brand new system. So that would be one thing I would kind of say, Brian, architecturally in the background for your IT team to look at bringing the aggregation of data and all the rules into a single place, controlled in a single place, rather than building all those rules into the source systems.
Thank you.
Thanks, Brian, for your question, and Dara for that response. I'm going now to a question from Kevin O'Connell. The question is, when do you anticipate companies will start engaging with external audit around assumptions, etc.? And have many companies started looking at moving to full IFRS in advance of IFRS 17 implementation to avoid doing both at once? And Kevin, I'm assuming that you're coming at this as a company that's not currently on full IFRS, so maybe on IFRS 101 or 102, 103. I'm going to pass this over to Ciara. Ciara, are you happy to take that question?
I can try. You might have thoughts on it yourself, actually, Olive. But I think it's a good question about engaging with your auditors. I think when I go through the standard, every piece that's about judgment, thinking as an auditor myself, at the back of my head, I'm like, well, who's going to decide whether we've, whether a company has met that judgment? And it's, at the end of the day, it comes down to obviously the CFO and internal management being happy, but also that your auditors are happy. So definitely on our larger projects, I know particularly, through the Paris office and stuff, that process has started a little bit and is definitely going to be ramping up, I think, in the next year. And then in terms of, if you're not using full IFRS, I think the companies that are IFRS 102 and 103 are very much currently in a wait and see kind of holding pattern, learning about IFRS 17 and becoming familiar with it. But as far as I know, haven't been taking, much substantive action yet, because I suppose there was so much uncertainty until quite recently, until we got the final version of the standard. And they're also, hoping to learn lessons from the IFRS reporters and maybe, pick up their resources once they've, become familiar with it, or, gain that expertise. But of course, being a huge project and everything that Dara said, I don't think you should wait and see for too long.
I'd agree with all of that, Ciara, and I'm not going to add any more to it. I think you've covered it well, thank you. There are two questions around PAA onerous contracts, how to check them, and the factors needs to be taken into account in evaluating those. We're going to come back to the asker on those, because none of the panelists are specific experts on non-life contracts, but we'll go to Tiago Pedro, our non-life director here in our Dublin office, after the meeting, and we'll get him to reply directly to you if that's okay. Okay, I'm just checking. There's another question on FRS 101, which is probably covered by Ciara's answer. I think it is from what I'm reading of it. So again, let me check if there. Okay, yes, I have another question. A question for Vinit this time. Vinit, you mentioned a P&L mismatch. Could you maybe expand on that a little bit, please?
So the P&L mismatch that I was talking about was in relation to the economic mismatch between the assets and the liabilities. So when you set up a discount rate, and I've talked this through in my presentation, that those discount rates would largely be based on a reference portfolio and not necessarily the actual asset portfolio that you use. So there could be wide differences between the two, and when you and as the actual events occur, your actual investment returns could be very different from the discount rates that you derive to roll forward. So these are the economic mismatches that will arise while setting in your P&L when you set your discount rates. So company must be wary of these mismatches, and they may need to try a couple of both the approaches and see how they're going to impact your balance sheet or P&L.
Thanks, Vinit. I think in the interest of time, any other remaining questions, we will contact those who asked the questions afterwards. And I'm now, I suppose, just before we wrap up, I'd like to leave you with our contact details. I'd like to thank our speakers for their thought-provoking presentations and insights. I'd like to thank you all for your participation. Sorry, I didn't mean to move on there for a second. It was great to receive your questions, and hopefully our answers helped you with your IFRS 17 projects, or as Dara would say, to know the enemy and to win the battles better. I'd also like to make you aware that Mazars and Raytig are happy to work with insurers, either separately or together, in relation to their IFRS 17 projects. And in that context, Raytig would provide their IntegraLinks IFRS 17 engine, their expertise in actuarial and financial systems, and that Mazars would provide consultancy alongside that to help you interpret the requirements, to work through decisions and choices, to understand impacts on the financial statements, and so on. And with that, therefore, I'd like to wish you all a lovely day. I hope today has been of benefit to you. If you have any feedback, we'd love to hear it. And as I mentioned before, please do watch out for the email where you will get a link to the slides and to the recording. Thank you very much. We hope to see you again and have a lovely day. Bye for now.